Good morning, everyone watching live here on BAM YouTube. Let me know in the comments which market you are tuning in from today. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will cover January CPI report fresh off the press and another drop in housing inventory. Today is Tuesday, February 14th, 2023. Happy Valentine's Day. I am Byron Lazine, and the hot sheet starts now. If you're with me live here on YouTube, hit that thumbs up. It's the best way to support this show and get it in front of more people that want this 24-hour look back on the housing market and how the economy is impacting it. And we had some real news today at 8:30 as inflation data and the CPI were released. Inflation rose 0.5% in January, more than expected, and up 6.4% from a year ago. Both of those numbers were higher than expectations. Okay, we'll talk about what the 10-year does, as we always do at the end of this show, what it's doing right now up to the minute. But we know the 10-year is going to have a reaction to this. We've seen in the last week, since we had that enormous jobs report just 2 Fridays ago, what's happened to the 10-year? The 10-year yield has been going up the last couple of weeks. It's impacted the 30-year fixed mortgage. So affordability all of a sudden, while looking good in the beginning of January for home shoppers, has gotten much tighter here just in the last week and a half, 2 weeks. This report here, I imagine, is going to keep that 10-year and that 30-year elevated as the markets continue to react, which they are doing as we speak. Okay, let's go to digging into this report here a little bit. Again, the CPI was up 6.4% from the same period in 2022, and this 0.5%, the 6.4% are both higher than what was expected. I'll switch over to Bloomberg, and Bloomberg states that this is going to add more pressure for the Fed to raise the rates. Okay, that overnight Federal Reserve rate, which they're going to meet here in just a few weeks now, because we're just outside of March. They're going to meet in the beginning of March and decide what they're going to do to the federal interest rate. We were talking just 2 weeks ago when they went up 25 basis points that we're likely to see another 25 basis point hike in March. There were some people that were hopeful they were going to pause. That's completely out of the question. I think there'd be a 0.0% chance of them pausing. What I think is more likely, and what it looks like the markets are anticipating right now, is that we're actually going to see a 50 basis point hike in March. Okay, so we saw 2 consecutive 25 basis point hikes in the last 2 meetings, the FOMC meetings, and now we're probably going to see, I would anticipate, a 50 basis point hike. Okay. And down below, you can get all these charts. I'm going to show you a bunch of charts here in just a second. You can get all of those in our daily download below. There's one link. It gives you all the sources that I use every day on the hot sheet, and it's going to give you all of these charts carved out for you. So you can see here that January is higher than any of the recent months here, going back into quarter 3 for the CPI. Overall CPI rises the most in 3 months, boosted by firm shelter costs. Okay, so they're looking at shelter as the biggest driver here, and let me tell you exactly what they're talking about. Shelter costs, which are the biggest service component and make up about a third of our overall CPI index, rose 0.7% last month. Okay, so housing, shelter rose 0.7 last month. Owner's equivalent rent and rent of primary residence increased by the same amount, while hotel stays also climbed. Because of the way the housing metrics are calculated, there's a significant lag between real-time price changes and the government statistics. The January report incorporated new weights for the consumer basket to try more accurately capture American spending habits. The shelter components are now a larger share of the overall index, while used cars make up a smaller portion. So they're weighting more heavily housing. We said yesterday that Jerome Powell and the Fed they do see disinflation in housing. And, they're looking forward and they expect that to start to reflect some of these numbers. Well, In January, those numbers did not reflect that sentiment. Okay. I also believe that rents are going to eventually come down. We have an oversupply of multifamily hitting the market in 2023. I do anticipate that rents will hit their peak and start to come down. That didn't happen in January. Okay, so this isn't great news for where we're heading into the future. Housing again, it was up the most significant in this report. And listen, it makes up a third of this index, but yet it impacted more than half. Okay, it was the largest contributor, accounting, I'm sorry, for almost half of the rise. Okay, shelter costs, they're the biggest service components, and they make up a third of the overall CPI index. But they impacted it almost half there. So let's take a look at some of these charts that you can grab, you can use in your marketing. Here's just where we're at for CPI going all the way back to 1965. Okay, so the blue line is the overall CPI, all items in city average. So this is an urban measurement, and then you've got the red line CPI for all urban consumers as well as rural. Okay, less food and energy in the U.S. city average. So you see here we do have this little decline, but going all the way back to the 80s, this is the highest in 40 years. You can see here a look back on the last 22 years, and there we sit on our 6.4 right now, and then 5.6 on this CPI for all urban consumers, less food and energy. Okay. That 6.4 number again was higher than expectations. The other way that the Fed's looking is this PCE, personal consumption expenditures index. I will say that we don't have that number today. It's going to be out February 24th. And the Fed would like to see that one go down. So if on February 24th, this PCE index goes down instead of, going the opposite direction like we saw here today with CPI rather, then that would be another good signal. We said it yesterday, we're in this like volatile situation where there's just all this back and forth information. In the comments, let me know if it's like every day it seems to change a little bit. That's certainly where we're at right now with inflation. That's definitely how I feel, where we're at this inflection point, and the markets, the forecasters, the economists, nobody has a real handle on what's going on. We're certainly not out of the woods yet. Okay, today was a big reminder as we look at the inflation report that we're nowhere close to this thing being over. We might have gotten ahead of ourselves at the end of 2022 and the beginning of 2023 when we saw all those positive reports. We're like, this thing's just going to keep going down. There's a chance that this thing, like it did in January, goes back up. And if it goes up too far, does it get out of control? I think the Fed's going to take an aggressive approach for rates, and they're going to increase them to 50 basis points when they meet in March, which is going to have an impact, yes, on the 10-year, yes, on the 30-year. We'll see what that impact is, but there certainly will be an impact. I mentioned that one of the bright spots today was that cars went down 1.9%. So you can see there, I mean, this new car prices soared during the pandemic and now is finally starting to go down. Interesting. Average payment for a new car is $777. That's double 2019. That is a ridiculous payment right now. I don't know. I don't understand what people are thinking spending that much on a car. I certainly would not do that, and I would hope that more consumers will consider putting their money to better use in this economy. Byron, what do you think that rent statement applies across? Do you think that rent statement across all price points, meaning that rent is this 0.7% going up? This is the overall. So, this is taking everything into consideration on an average. I don't know if you mean the statement that I made that I believe rents are going to go down. I think in these higher price rents, these luxury apartments, which they built so many of them, yeah, that's going to take a bigger hit than affordable rent for sure. I don't think affordable rent is going to drop because it's already considered affordable. That's going to have the most competition for sure. Okay. So there you go on the CPI report from today. Not great news, not great news at all that, consumers basically, the consumer price index climbed in January. It's the most in 3 months. Um, Energy and shelter costs were the biggest contributors to that, and certainly it's up 6.4% from a year earlier. They were looking at a 6.2% reading. That's where expectations were. Where we would end up. We're not there, so we're not doing as well against inflation as we might have thought we were just a month ago. There's a longer road. This tells me there's a longer road to recovery. This also tells me that the chances of a recession, to me, are more than likely. I mean, just look going back to 1965. I'll show this chart once more here. Every single spike in inflation, okay? Every single spike in inflation, these gray bars are recessions, okay? Every single spike in inflation is met by a recession, except for ours right now. We have great jobs reports. I get that, but I don't anticipate us escaping the R word here in 2023. I believe that the Fed has already, said it. They're deliberately going to put us into a recession if that's what it takes. And I think that with the jobs report and then what we're seeing here, another tick up in inflation, they're going to be aggressive in March. And we start talking about 50 basis point hikes again. We definitely could likely see a recession. I don't have any information that you don't. I'm just, saying what I think could happen. Okay. What's going on right now with inventory in housing? Okay. Because we know that this is, despite what all of the, people that are just rooting for a complete economic collapse in housing, a price collapse in housing, say, we know that inventory is keeping prices elevated. It's keeping prices elevated in a big way because there's not nearly the demand we had in 2022, but there's still steady demand. There's still this seasonality demand, even with interest rates being where they are today. Okay, we have demand for housing. We have this huge generation, the millennial generation, that is buying homes. Okay, we have boomers that are moving around, and this, every time we have this drop in inflation, we kind of see like a competitive environment, a pop almost in prices. Let me know in the comments if you agree with that, or hit the thumbs up if you agree. And so every time in inventory drops right now, it's like, uh-oh, how much are prices going to go up? See, when I see that, I know that prices are likely going to pop in some markets as opposed to drop overall across the country, like a lot of people are projecting. Weekly housing inventory, though, continues to decline. We saw a decrease of 1,328 units in the last week. That's double the amount that we had this time last year. Of course, we're working from a higher level in 2023, but we're still at historically low inventory levels. This is mind-boggling to me. When you look at this chart here, and this is going back to the 1980s for inventory in this country. I'll move it here so if you're on YouTube, you can see this. Look at how low we are. Last year was, apologies there, last year was the lowest level of inventory. And we're at the second lowest level of inventory all time. All time, okay? This line, nothing has even come close to it in terms of inventory. Not in the 80s, not in the 90s, not in the 2000s before we had the run up, in the great financial crisis. Certainly not in the mid 2000s, not in the 2010s. These are the two lowest years for inflation. So as we continue to lose inventory, which is what's happening right now, and in fact, this time of year, you typically see when it hits a bottom and an inflection point like we have right here, that's when you start to see inventory go up. We're still waiting for our seasonality pop. Instead, as you can see here on the weekly chart from Altos Research, that we hit and then we kind of popped back down. Okay, so where's the true bottom going to be? Everybody anticipates that we'll get some increase in inventory here from a seasonal approach. But in the last week, we did not get that. We continue to see, unfortunately, inventory going down, and that's a decrease of the 1,300 plus units in just the last week. So the weekly inventory change, and this is on Housing Wire's Market Watch that Logan puts out every single week. This is a forward-looking market watch. So everything, all the data in here is okay. Well, how can we project out into this spring market? You see here the inventory change as it relates to this past week, and then from the same week last year. Okay, the same week last year when everybody says inventory is way up and they're going year over year, they're going off the absolute bottom, the lowest number of all time. Okay, so we're still below 1 million units right now in total inventory. Again, this number here is just properties that are available. 330 million Americans. There's 443,000 available housing units that can actually be bought. This number here, this 970,000 level, this includes properties that are under contract. This is that trading economics chart that I just showed you here, where inventory just continues to plummet in this country. That's going to keep prices elevated. Out of those 970,000 homes, are really, I like to look at this number more, the 443,000. Well, what is good inventory there? You know, what is actually buyable or affordable inventory for today's homeowner that's using a mortgage? Okay, that number is even smaller, I promise you that, than 443,000 homes being available. If we're talking affordability and if we're talking move in and somebody that can, you know, qualify with a mortgage on the property. So as we continue to hit these bottom levels of inventory, and we're in the spring market where more buyers are going to be shopping than they will later in the year, we're going to see prices hold. In fact, Zillow just came out and said, well, hey, we believe we're changing our estimate. We believe in 2023 that we're going to see prices go up 0.5%, up 0.5% across the country. While you've got all these, you know, doom and gloomers saying down 10, 20, 30%. You know, Zillow, who's got a bunch of data, and I'm looking forward to the earnings report tomorrow night. We'll cover it on Thursday right here on the hot sheet. They're saying, no, we're actually going to see prices increase in 2023. That's not, I'm not like saying this is a great thing for what the Fed's going to do or anything like that. They want to see housing continue to go down. These prices are kind of fighting that trend. Okay. And so here you go. You can see we're going to talk about the 10-year in just a second. You can see the 10 years really battled back up over 3.7 in the last week. We need this number to go down if we want affordability in the 30-year fix to get helped out. We talked about the CPI already. So inventory not yet helping us. Hopefully we'll see inventory levels go up. We need inventory levels to go up, and we need this 30-year fix to go back down closer to a 5 handle, or at least the low 6s, for more buyers to find home shopping affordable. That being said, I don't know where the inventory's coming from. And if you know where it might come from, let me know in the comments. I'd love to hear your thoughts on that. I just don't see it right now, which is why I think prices are going to continue to battle this trend of affordability, unfortunately, until we figure out a way to actually help builders out in this country. Okay, let's see where we're at up to the minute on the 10-year yield. And unfortunately, after the CPI data again today, following the trend of the last week and a half, 2 weeks, we're on an upward trajectory on the 10-year yield. We're up over 3.7 once again. We were up over 3.7 yesterday when we did this show. And yesterday, the 30-year fixed went up to 6.54%. I could envision this going up again today, maybe even as high as 6.6. It's crazy because just a week and a half ago, Thursday, right? Not this past Thursday, but Thursday before that, we were at 5.99 on the 30-year fixed. And now today, we're likely going to be closer to 6.6. I don't see any indications of why this thing would drop under 6.5. And so there you go. I do believe that if you're a real estate agent, right now is a very important time to get out there and just, talk through what's going on. Hey, inflation's back up. Hey, the 10-year and the 30-year are reacting to that, and they're going up. Okay. And it's likely that we could see, it's getting more likely, in my opinion, that we could see a 30-year fixed of 7%. So if you're, you know, if you're in a position where it's like, okay, this payment is affordable, and there's a whole nother debate there, right? People are getting into a more unaffordable payment, more so we're kind of hitting that peak right now. But if for you as an individual, your particular payment is affordable and you need to buy a home, you need to move, you need the shelter, and you want the home, you need to go make that move now. I don't think, anticipating a 599 next week is a likely scenario. Okay. I don't see any trends that show us there's a lot of volatility. So I could come on here next week, be completely wrong. Something could totally shift and we could be back down to 599. We've seen it jump up 0.5% in a week, right? That these are abnormal jumps that we're seeing with the 30-year fixed, but you can't predict where the volatility goes because it's just as likely that it could go 7%. So these are real conversations. The second half of the year for real estate agents in particular looks a lot more murky than this market right now. Take advantage of the seasonal market in terms of just your ability to service people and to do deals out there. Because when we go into a recession, I'm saying when now, not if, because it looks more likely than not that we will go into a recession. We just don't know how deep it's going to be. There's a lot of expectations that it's going to be shallow. Certainly 2 weeks ago, with the data points we were receiving, that seemed more than likely. And then you get some data points here the last week and a half and today's CPI that suggests, okay, well, this could be a longer road to recovery. Take that into consideration in your business building. Take that into consideration in the way you're spending. Take that into consideration on saying, hey, right now might be the time not to take my foot off the gas pedal and building my business and serving others. It might be the time to do a little bit more. Okay. Because, the winter could be in the summer. The winter could be in the fall. We just don't know where this thing's going. All right. Today we've got a Real Word podcast with a co-host guest. Nicole is out today, and I've got a surprise co-host that is an amazing co-host here on Valentine's Day. That's going to be premiering at 2 p.m. You do not want to miss that. Also, the AI Tools ebook, we'll link that down below. We have a Chat GPT workshop. Chris Smith and BAM collabing on a Chat GPT workshop. There is a link below where you can sign up directly for that workshop. That's Thursday, 10 to 1. There's also an exclusive offer from BAM to be able to get your ticket to that. We've had thousands download the ebook and already hundreds sign up for the workshop. You do not want to miss that. Everything you need to know. If you're confused about ChatGPT, how to work it, how to use it in your business, do not miss this workshop we're doing on Thursday with Chris Smith. The link is down below. Appreciate all you guys. Happy Valentine's Day. Put your head down and get after it right now. I think the spring is going to be the best opportunity for everybody in real estate to make an impact on their 2023. We've got a retail sales figure report coming out tomorrow. Hopefully that's a little bit better than today's CPI. We'll talk about it all on tomorrow's hot sheet, 9:30 Eastern time. Till then, toodaloo.